Hello, this is Bill Scheid, and in this presentation we're going to look at 3 Ken Long concepts and their results. You don't have to study with Dr. Ken Long for a very long time to realize that he is a continual stream of genius-level trading concepts. I like to joke that studying with Ken is like drinking from a high-pressure fire hose. So as a way to focus in on the incredible value of his teachings, in this presentation, I've narrowed down the top 3 Ken Long concepts, the top 3 concepts I've learned from Ken Long. And for each of these 3 concepts, we're going to look at what is it, how do we apply it, and what kind of trading results can we generate with these concepts. Before we jump into it, please consider yourself disclaimed. There are a number of important points here, including but not limited to the fact that I am not a licensed financial professional or advisor of any kind. I'm a systems researcher and a trader, so that means that this is an educational presentation and nothing I present here is intended as investment advice, financial advice, tax advice, any kind of advice at all, nor is it a solicitation to buy or sell any asset or use any broker, strategy, stock, bond, ETF, etc. Everything here that we're talking about is educational. Also, I am going to be sharing with you systems and strategies and assets that I personally trade, and there's 2 things you should know about that. First, because I'm actively trading what I'm sharing with you, you should assume that I may or may not already have a position in the stuff that we're talking about. And second, by me talking about my use of these systems and strategies, brokers, assets, etc., I'm not recommending that they're right for you, nor am I making any guarantees about their future performance. Of course, past performance does not guarantee future results, and your mileage may vary. The first Ken Long concept we're going to look at is the PSAR on the RL10. And as I said earlier, we're going to answer these 3 questions. What is it? How do we apply it? And what are the results? So what is the PSAR? PSAR stands for Parabolic Stop and Reverse Indicator. It was first developed by J. Wells Wilder Jr., who is an American mechanical engineer and technical analyst. And you may know him because he is also the father of ATR and RSI, which are 2 other indicators that are quite popular. The PSAR is an excellent indicator, but like all things, it does have strengths and weaknesses. One of the weaknesses is that the PSAR indicator, when it's applied to price, can be quite whippy. It can flip from long to short quite quickly and easily. So the solution to this, which is an ingenious innovation pioneered by Dr. Ken Long, is to apply the PSAR to the RL10 instead of to price itself. As you may know, the RL10 is a 10-period regression line curve, which represents the mathematical best fit line for a set of data. The RL10 is essentially a smoothed version of price, and applying the PSAR to the RL10 means that there's less noise than applying the PSAR directly to price. So the effect of that is that the PSAR is less whippy. It flips less frequently in choppy markets, which is really an ingenious solution on Ken's part to the one weakness of the PSAR as it was created by Wells Wilder. Now, how do we apply the PSAR on the RL10? One system that prominently features the PSAR on the RL10 is the PRX crypto system. And this one indicator, the PSAR on the RL10, plays a number of very important roles in the PRX crypto system. It has a lot of jobs and it performs a lot of important functions. So first of all, it functions as a tactical trend indicator. So which way are we going? Long or short? It also serves as a tactical trend reversal indicator. So we use the PSAR to see when a trend reverses. It also functions as a place to set initial stops. It functions as a place to set trailing stops. And as a place to set trailing stops, the PSAR continually reduces risk in the trade over time because it moves regardless of whether price moves. This is a function of the acceleration factor in the math behind the PSAR, and it translates directly into cutting losses quickly. If price just moves sideways, the PSAR moves up on its own because of the math, and it eventually gets us out, so we're being capital efficient and time efficient with our trades, as well as taking smaller losses. The other nice thing is that as a trailing stop, the PSAR gives price plenty of room to run. So this translates into letting winners run, creating large R multiple wins, and leveraging the belief that the trend is your friend. Also, the PSAR on the RL10 is what helps the PRX crypto system adapt to volatility. So as an inherent function of the math involved with plotting the PSAR on the RL10, there's a direct correlation between volatility and the distance between price and the PSAR dot at reversal points. So this means that as volatility increases, our initial stop will be further from price, giving the trade appropriate space without getting stopped out, as well as giving us a manageable position size in rough seas. I've heard traders complain in the past about not being able to trade markets because they're too volatile, and I agree that using methodologies that are not volatility adaptive in highly volatile markets is not a useful idea. However, in my view, being able to adapt to volatility is a make or break element of trading crypto or any market really. And the PSAR on the RL10 is a major way that we adapt to volatility in the PRX crypto system. So what are the results? What are the results of applying the PSAR on the RL10? Well, as a way of highlighting just how versatile the PSAR on the RL10 is, we're going to look at results on 3 different time frames. So for swing, we're going to look at the PRX crypto ETF swing system. For intraday, we're going to look at the PRX at one version of the PRX intraday system that trades on 30-minute bars. We have versions that trade on smaller time frames as well. And for longer term, we're going to look at the PRX weekly system. And what we're going to do is look at backtest results as generated by the PRX strategy on TradingView. So for the PRX crypto ETF swing system, we have an SQN 100 of 3.87, which by Dr. Van Tharp's definition makes it an excellent system. We have an expectancy of 1.78. Yes, the decimal point is in the correct place, not 0.178, but 1.78, which is very high for a swing system. The reliability is 58% and the win-loss ratio is 5.6 to 1. For the PRX intraday system, the SQN is 5.53 on the SQNN, which by Dr. Van Tharp's definition makes it a superb system, and he says few exist. It has an expectancy of 0.24, a reliability of 37%, and a win-loss ratio of 2.86 to 1. For the PRX weekly system, the SQN 100 is 6.37, which by Dr. Van Tharp's definition makes it a superb system, and he says few exist. It has an expectancy of 2.26, a reliability of 73%, and a win-loss ratio of 4.45 to 1. So here we see that the concept of the PSAR on the RL10, when applied through the PRX crypto system, indeed generates some very impressive results. The second Ken Long concept we are going to look at is momentum. And again, we'll look at what is it, how do we apply it, and what are the results. So what is momentum? Well, to oversimplify, momentum is the capacity for a price trend to continue. It can be helpful to look or to think about the relationship between the concept of momentum in the world of physics and the concept of momentum in the world of finance. So in physics, momentum is a quality possessed by an object in motion and is a product of the size and the speed of that object. This connects to Newton's first law of motion, which states that objects in motion tend to stay in motion. In finance, momentum is a quality possessed by a market in motion and is a function of the size and speed of the trend. This connects to the market belief that the trend is your friend. So momentum is a concept that allows investors and traders to profit from the herding behavior of market psychology. Buy high and sell higher is the idea behind momentum. The concept of momentum itself has been tested in the scholarly literature and is an academically rigorous concept. You can see the research done by any of the authors here. And of course, if you've studied with Dr. Ken Long, then you know he has also taught momentum as part of his BMR systems for decades. So how do we apply momentum? So our momentum-based monthly asset allocation systems are powered by the concept of momentum. And in these systems, momentum helps us in a number of ways. So first of all, we use momentum to identify and quantify trends across the world's major markets. Momentum also gives us the ability to allocate portfolio assets to the world's best performing markets, and that leverages the herding behavior of market psychology, and it allows us to profit from trend continuation. What kind of results can we generate with the concept of momentum? Well, here we're looking at backtest data for two momentum-based monthly asset allocation systems. On the right, in green, the first column is a standard out-of-the-box system that's very similar to the first generation BMR systems taught by Dr. Ken Long for the last decade plus. The second column in green is a second generation system that I've developed that adds optional volatility stops and short positions. On the left in tan, the first column is the buy and hold performance of the S&P 500 and the buy and hold performance for a globally diversified buy and hold portfolio comprised of 60% stocks and 40% bonds. For the first 5 metrics here, that's total return through ending balance, we see that the standard first generation configuration of momentum system beats the S&P 500 on all of these metrics. We see that for this period, the S&P returned 323%, while our standard first gen configuration of momentum system returned 693%. The S&P had a max DD of minus 52.3%, maximum drawdown that is, and the system had a maximum drawdown of minus 34.3. The S&P's CAGR was 9.5%, while our system had a compounded annual growth rate of 14.2. The S&P had a return to drawdown ratio of 6.2, and the momentum system 20.2. Ending balance down here, this uses a hypothetical starting balance of $100,000 and assumes 16 years of growth at the given CAGR. And for the S&P 500, our 100,000 turned into 427,000. For the system, our 100,000 becomes 838,000. We can see here also the expectancy of the system is 0.38 and the SQN is 3.31, which by Dr. Van Tharp's definition makes it an excellent system. When we add the optional second generation volatility stops and short positions to our momentum system, the numbers get even better. The return jumps to 960%, the maximum drawdown gets cut in half to 15.7%, CAGR jumps to 16.4%, return to drawdown ratio triples to 61.1, and our hypothetical 100,000 turns into 1.14 million. The expectancy becomes 0.45 and the SQN is 4.05, again making it an excellent system by Dr. Van Tharp's definition. So here we can see that concept number 2, momentum, as applied to our monthly asset allocation systems, has some pretty fantastic results. The third concept we'll look at in this presentation is the concept of moving averages. And what are moving averages? In their most simple form, a simple moving average is the mathematical mean of a set of price data over a specific number of bars. And there are several benefits and uses of moving averages. They smooth price data by creating a continuously updated average price. They can be used to identify trend. They can also be used to classify market type, and they can be used to determine support and resistance levels. Moving averages are a very common indicator that's widely used in technical analysis, with the 50-day and 200-day moving averages being used quite popularly, and these are generally considered by the trading and investing public to be important trading signals. The concept of moving averages has been tested in the scholarly literature and is an academically rigorous concept. You can see the research done by any of the authors here, and of course Dr. Ken Long has used moving averages in his work for decades. So how do we apply moving averages? Well, our portfolio moving average monthly asset allocation systems are driven solely by the concept of momentum. They are very simple systems, and in these systems, moving averages help us in a number of ways. So we use moving averages to assess market conditions across the world's major markets. We allocate assets to global markets with the most favorable conditions. We avoid major bear markets, and we do that while capturing long-term trends and avoiding market noise. So what kind of results can we generate with the concept of moving averages? Here we're looking at backtest data for 3 portfolio moving average monthly systems. On the left in blue here, the leftmost blue column, this system called PMA Low is a system I built for the objective of conservative growth with lower drawdowns, with the goal of outperforming the 60-40 buy and hold approach. The next column, or let's go to the third column here, PMA High. This is a system I built for the objective of aggressive growth where higher drawdowns are okay. And the column labeled PMA Medium was built for the objective with medium growth and medium drawdowns. On the left in tan, again, we have the buy and hold performance statistics for the S&P 500 and for 60-40 stock bond buy and hold approach. So here we see that the PMA Medium and PMA High both outperform the S&P 500 on all of the first 5 metrics in the left column. So that would be total return through ending balance. These two also have excellent SQN scores of 4.02 and 3.39 with expectancies of 0.36 and 0.34. PMA Low was designed to beat the 60-40 buy and hold, and PMA Low does beat 60-40 buy and hold on all of those first 5 metrics. Plus, it also beats the S&P 500 in terms of maximum drawdown and also in terms of return to drawdown ratio. It has a good SQN of 2.85 and an expectancy of 0.26. So in summary, we see that these simple systems based on the concept of moving averages achieve excellent results. If you'd like more information about the PRX crypto system and its use of the PSAR on the RL10, please get in touch with me at any of the coordinates on the left. If you'd like more information about the monthly asset allocation systems and their use of momentum and moving averages, please get in touch at any of the coordinates on the right. Thanks for watching. Happy trading and happy investing.